Hello, I'm Blake, and welcome back to Financial Markets Language. Today we're going to be going over what happened at the tail end of last week, and then going to be getting you guys ready for Monday and the rest of the week this week. At the end of last week, we saw quite a rally in the market. Friday, the last day of the market, we saw the market go up. Dow Jones 1.2 approximately, S&P 500 1.6 approximately, and the Nasdaq went up approximately 1.9%. Definitely was quite a rally of a day. Futures for the day were even up higher, but as far as the reason for this, it's more or less the same that we've been getting. The dollar plunged down, bond yields went down a little bit, reversing a few trends that we had the previous week, which saw the exact opposite, but more or less the same of, the dollar and bond yields controlling the market and the market reacting pretty much in step with whatever they're doing. One big notable exception is we continue to see a rally in oil. Don't get me wrong, the dollar went down, but even the day previous, the dollar went up, oil continued to go up, dollar went down, oil still went up, and that continued to hold trend with the gasoline RBOB, wholesale gasoline within the U.S., continued to go up. So definitely be expecting gas prices the next week or two to tick up anywhere from 15 to 45 cents at your local pump, depending on where exactly you're living. But more or less of the same that we've been getting. As far as things that we got on Thursday, we got the initial joblessness claim. It was predicted to come in at 197. Last month it came in at 192. Take in mind these are in thousands, but it ended up coming in at 190. Still showing that employment is pretty strong, easy to get back into a job, or the fact that it's just hard to claim unemployment benefits, but still shows that we're not seeing a huge loss of jobs, at least from the initial joblessness claims. As far as the U.S. productivity revision, we saw quite a large revision down. It went down to 1.7%. This was much lower than the 2.5% that was predicted, and much lower than the Q3 estimates, where this is Q4, so the entire September through December time frame. But the Q3 was at 3%, so quite a drop down for the final revision. And then as far as U.S. labor costs, we saw that go down to 3.2%. This was much lower than the 1.4% that was predicted, or much higher than the 1.4% predicted, showing that labor costs continues to go up despite productivity not going up. So the unit labor is the amount of cost relative to the amount of labor being produced. So it just shows that to get the same amount of work, people are having to pay 3.2% more just in Q4. And take in mind, obviously this can't be 100% accurate, but that definitely keeps in line with what we've been hearing and what we continue to see in the market. As far as the data that we got on Friday, we saw the S&P Global U.S. Service PMI, more or less measuring services. Remember, anything above 50 is growth. So we did predict a small growth. Last month we had 50.5. We were predicting another 50.5, again a small growth, and we beat it slightly with 50.6. I don't really predict this to be that notable. That's relatively a very, very small move, but shows that it's not declining, which obviously people that are hoping for inflation to go down sooner than later are definitely hoping for. And then as far as ISM services, we saw them go up 55.1%. This was higher than the 54.3% predicted, but less than the previous month, which was 55.2%. As far as things coming up, this upcoming Monday, the only thing we have is the factory orders. The previous month it came in at 1.8. This month we're predicting a negative 1.8%. And even though we're in March, this is definitely a very delayed indicator, and this is reporting for January. So keep that in mind. This is just January's numbers that's getting reported. There's just almost a 2-month delay on when it gets reported, or a full month and week delay. But other big things that are coming in this week, We have the job openings, or the JOLTS. That's one that's coming out on Wednesday that a lot of people have their eyes on. And obviously that's going to be followed up with the most important, the big employment report. But obviously the JOLTS will give us a little bit of insight for hopefully what we should see for the employment report. Take in mind, the January report that came out in February was extremely hot. It was the biggest miss in government data since the 1980s, and came out almost more than double than what was predicted. Came in at 517,000 new jobs created. This month we're expecting to create 222 or 25,000 jobs. So definitely a lot less than the previous month, but obviously a lot more than, you know, the unemployment claims that we just had, showing that employment's continuing to grow. And obviously, given, you know, the current wage price spiral that some people are worried about, and with things like unit labor costs continuing to go up, this is definitely sending a bad trend to the markets and could worry some investors going forward. One other big notable thing is we saw the VIX crash down to 19, almost right below 19 at the high 18s. This definitely means that, I mean, if you're looking to get into, you know, options contracts, the price premiums are going to be much more attractive to enter in now, just because volatility is so low. So the implied volatility of most stocks are going to be much lower than average, causing the initial buy-in to be significantly less. So if you've been waiting to put in some long-term options, either calls or puts, don't get me wrong, there's been a little bit of additional hedging in the last 2 weeks, so put premiums are up a little bit. But with this big drop in the VIX, you should definitely see a lot of those come down. Not to mention the small rally that we had last week that definitely, you know, flooded the market, you know, made long-term option plays considerably cheaper, assuming you're planning on buying at the same strike price. I'm currently recording this early on Monday morning, and it does appear that futures are pretty unchanged. Bond yields are pretty unchanged. The dollar is pretty unchanged. So it appears that we're going to be going into this Monday open with pretty unchanged results. So hopefully this results in a muted market today. We saw quite a big rally yesterday. I think a lot of bulls would just kind of hope for, you know, if you're planning on being long-term long, would kind of hope for something a little bit more stable, because if we see a big run up, that could easily get a lot of people worried that, you know, it's just people getting ready to hedge. And you know, when volatility or something unusual, take in mind we've been having some bad inflationary data, so a lot of people would be predicting this market to be going down in the last month, but we've saw quite the opposite. Definitely giving a lot of people a lot of skepticism as to what exactly is causing this rally, and a lot of people to pull back their current investments or to hedge even more, which obviously recently has caused even more losses for those individuals, unfortunately. But even though it is a smarter move, but, you know, in general, the best strategy for a long-term investor is just to buy and hold, stay long, and whenever there is an attractive price option, as in you really find the PE at that current price very appropriate, to buy at that price and continue holding. One of my favorite, you know, just Warren Buffett type of investing strategies is to do your analysis without looking at the price of the stock. Look at the price of the stock after your analysis, because at that point, you know, you'll come to your conclusion without any of the market bias, without other people in the market more or less telling you what should be valued at. You'll be able to get your own evaluation and then compare that with what the market's currently pricing it at. And then potentially you could dig in deeper, see why there's a discrepancy, or just flat out know that, you know, this stock is currently under or overvalued, and play that play accordingly. But obviously the best long-term wealth gaining strategy is just to stay long. Obviously that hasn't really held true in the last 18 months, but, you know, if you look on a 1 to 2 decade scale, it's almost impossible to ever lose money in the market, as far as American history, even dating back to the Great Depression. That's all I have for you today. Thanks for coming back, and I hope to see you again tomorrow. We'll be breaking down what went on in the market on Monday and be getting you ready for what's happening Tuesday.